Hello. In this video, we'll be going over non-cash acquisitions paid for with deferred payments. We've discussed in previous videos about acquiring long-term assets, specifically property, plant, equipment, or intangible assets. Well, usually, so far what we've discussed is companies acquiring them by cash, but they can also acquire assets without paying cash. They can use deferred payments, which is what we're going to discuss here. They can issue stock as a payment. They can donate assets, or they can exchange non-monetary assets for other assets. These will be covered in other videos. In this video, we're going to be talking about deferred payments. And deferred payments are notes payable. So basically it says, I'm going to acquire asset, A, and I will give you money at a future date with interest, usually, or some sort of interest component to it. Assets acquired in a non-cash transaction are either valued at the fair value of the assets given or the fair value of the assets received, whichever is more clearly evident. Let's go through an example using deferred payment as a method of paying for an asset, and that's issuing a notes payable. On January 2nd, 2027, the Midwestern Steam Gas Corporation purchased industrial equipment costing $41,323. Instead of paying cash immediately, Midwestern signs a note requiring payment in 2 years plus annual interest of 10%, which is considered to be a realistic note. So the Midwestern Steam Gas gets an asset, and they're going to give money in the future to whoever they purchased it from. And so now they owe money to whoever they purchased it from, and they're going to have to book all these entries. So let's go through it entry by entry. On January 2nd, they acquired the equipment. So they're going to debit equipment for the purchase price, right? $41,323, and they're going to credit notes payable for the same amount. So now they owe $41,323. And they don't have to pay it back for 2 years, so not until December 31, 2028. But however, at the year end of 2027, they have to accrue the interest component of the note payable that they will owe in the following year. And the way they do that is they're going to debit interest expense and credit interest payable, and they're going to take the face value of the note at $41,323 times 10% is $4,132 in debit interest expense and credit interest payable. On December 31, when they have to pay the actual amount to whoever it is, they're going to debit the note payable for $41,323, right? That's this right here. They're going to debit the interest payable that they booked right here. So they're going to debit interest payable from 2027 for $4,132. And then they also have to pay interest from 1/1/28 to 12/31/28. They also have to pay interest on that, right? The $41,32 is for the 2027 component, and now we have to pay for the 2028 interest component. The way this is done, and we've seen this before, is you have to take the carrying value or book value, however you want to call it, times the effective interest rate or the market rate, which we're only told one rate here, so we know that's 10%. And the carrying value is going to be the beginning carrying value plus any the interest component that we owe times the 10%. And so that gives us $4,545, and that is interest expense. So notice we have now paid interest expense for $4,132 plus $4,545, right? That's how much interest expense is on this actual note. And that ends up being cash of $50,000. So we pay the seller $50,000 at the end of 2 years for equipment that cost us $41,000. Now, what if we acquired an asset and was just told what we have to pay at the end of the term? So let's look at a similar example. On January 2nd, 2027, Midwestern Steam Gas Corp purchased industrial equipment. So far, the same. In payment, Midwestern signed a non-interest bearing note requiring $50,000 to be paid on December 31, 2028, which is 2 years later. If Midwestern had borrowed cash to buy the equipment, the bank would have required an interest rate of 10%, and the equipment is custom built, so its fair value, which is the cash price, is unavailable. So now we have a non-interest bearing note to be paid of $50,000. And what non-interest bearing notes are is within the payment that you're owed at the end of the note, there is an interest component in that payment. And what we have to do, because there is no fair value, we have to strip out of this $50,000, how much is interest, because that's not part of the cost of that equipment, right? That's not what we're going to capitalize on our balance sheet. And the way we do that is so we're going to have a notes payable on January 2nd for $50,000. We know that. The way we calculate how much to record as our equipment cost is we have to find out, we know that if I'm going to look here, this is on 1/2/27 and this is on 12/31/28, right? And this is, let's call this 12/31/27, right? On this date right here, I'm going to have to pay $50,000. So I have to know of that $50,000, what is that in today's terms? So I'm going to present value that 1, 2 periods, right? And so I just wanted to draw that so you can see that, and I'm going to erase it just so we have more space right here. And so what we have to do is when we take our present value, we know that the calculation for present value would be 50,000 times a present value. And so we're going to take 50,000 times n equals 2, that's the number of periods, I equals 10. And when you look at the present value table, it's going to give you 0.82645, which equals 41,323. I want to quickly, I know we've done this in a previous chapter, but I'm going to go to the present value of a dollar just to kind of remind you how to look up the present value of a dollar. Right here, this table, present value of $1. We're going to look at n equals 2, the column, this column right here gives you the number of periods right there, and we're going to go all the way to 10%, and that's how we get the 0.82645 number, just as a quick reminder. So when we take the 50,000, right, times the present value, we get the fair value of the note is 41,000. So that's how we book debit equipment 41,323. We have a note for 50,000 because that's what we're going to have to pay. The difference is going to be a debit, and this is called a discount on notes payable. I can't remember if we've seen that before or not, but it is a contra liability account to the notes payable. So when you look at the carrying value of the note, you always take the face amount, which is 50,000, minus whatever the discount on it will give you the carrying value of that note. And this comes into play because for when we book interest expense, and you'll see. So the way we're going to record this entry is we're going to first at the end of the year, because we acquired this equipment on 1/2/27. So on 12/31/2027, we're going to accrue the interest. We're going to take the cost of the equipment, the 41,323 times 10%, right? So that's 4,132. And notice here, we don't record credit to interest payable because this is a non-bearing interest note, non-interest bearing note. We're going to credit the discount on notes payable for the $4,132. Let's just draw a quick T account just for the discount amount. We debited 8677 the prior slide, and here on 12/27 we have a credit for 4132. Here the 86 was from 1 to 27. Okay, now let's fast forward. So that's just what we record at the end of year one. The end of year two, we actually have to pay out this note. We know that the note that we have to pay out is $50,000. So let's just do the second entry first, just because it's easier. We're going to debit our notes payable at our face amount of $50,000, credit cash $50,000. That part is pretty simple. We also have to pay interest on the second year of the note. We've accrued the interest expense for year one, and we have to accrue the interest for year two. Again, same as before, the way we're going to do that is we're going to take the carrying value of the equipment plus any interest expense that we've previously booked times 10%. And that gives us $4,545. So we're going to debit interest expense for that. And then we're going to credit the discount on notes payable for 4,545. That's going to be on 12/28. And if you take that, if you look at this T account, at the end of December 31, 2028, our discount on the notes payable is 0. And it should be 0 because now we're paying off the note and we have nothing left on our balance sheet related to this note. And there that is. Now let's look at a non-interest bearing note, but in this situation, the fair value of the asset is known. Remember in the previous one, we didn't know. We just knew that the note was for $50,000 at the end of 2 years. This one is on January 2nd, 2027, Dennison Inc. purchased equipment and signed a non-interest bearing note in payment. The note requires the company to pay $100,000 on December 31, 2029, which is 3 years later. Dennison does not show what interest rate appropriately reflects the time value of money. However, the price list indicates the equipment could have been purchased for at a price of $79,383. When we know the fair value of the asset that we are acquiring, right, which is usually the cash price, that is what the amount that asset will be capitalized at. So we know we are going to have a debit to equipment for $79,383. We know also then 3 years from now, we are going to owe the seller $100,000. So we're going to credit the notes payable at its face amount of $100,000. And the difference of $20,617 is the discount on the notes payable. So we're going to debit that. So that's our first entry that we need to know about, or the entry on 1/2/27. Now we have to, we're going to have to accrue interest for 3 years, right? Because we acquired a 1/27, and we're going to have to pay interest through 12/31/27. 12/31/28 and through 12/31/29 when the note is due. So we have to know what the interest expense is going to be for each of these 3 periods. We also know that in order to calculate the interest expense, we need to know the interest rate, which we are not told in this problem. So we need to figure it out. The way we're going to do that is we're going to figure out the present value. We know the present value of this note, and we know the number of periods is 3. It's a 3-year note. So when we try to calculate the present value of $1, the formula is that you take the face amount times the present value factor. So what do we know? We know that the present value is $79,383 equals 100,000 times some number, right? And that number is coming from the table. That's what we're trying to figure out, this amount. It's a present value factor. The present value factor, right? So if we take both these, if we divide by $100,000 on each side, then we know that the present value factor is 0.79383. And we know that our number of periods is 3. So we're going to have to go to the present value of a dollar table and try to find the one that says that the factor is 0.79383 with n equals 3. So let's go to n equals 3. Right here, I'm going to highlight it. And we need to look for that 0.79383. And so when I go here, you can see that the numbers are decreasing as the interest rates go up. So when I go to the 8%, here's my 0.79383, which means that my interest rate implicit in this note is 8%. Oops, right here. And that's what we're told here. Now we can calculate the interest expense for each of those years using the interest rate of 8%. And that's called the implicit rate of interest. Let's do a concept check. On January 2nd, 2027, Edgar Inc. purchased equipment and signed a non-interest bearing note in payment. And the note requires the company to pay $200,000 on December 31, 2029. Edgar is not sure what interest rate appropriately reflects the time value of money. However, the price lists indicate the equipment could have been purchased for at a cash price of $120,000. So here's what we're told, right? We purchased it on 1/2/27. This note is due 12/31/29, and that is for $200,000. And we have some interest component, right, for 1, 2, 3 periods. And we know that the cash price is $120,000. And it says, Edgar records the asset at what price? Even though the problem tells us that Edgar is not sure what interest rate appropriately reflects the time value of money, for purposes of knowing what to record the asset at, that is irrelevant. The asset is always recorded at the cash price. If we know the cash price like today, that's what it would be recorded at. We would debit, is this equipment? Equipment for $120,000. We would credit a notes payable for $200,000, and we would debit the discount on note payable for $80,000. If this was and we could figure out the interest because we know n equals 3 and work backwards from the present value tables. But for this purpose, we're just looking for the cash price for what we capitalize the equipment at, and that's $120,000.